or not, how do these structures affect your borrowing capacity?
In great question.
One way or the other.
And it's a very interesting question to do that. And to maximise the effect of the borrowing capacity, we like people over time, if they're not self-employed, we like people to set up what they call now a side hustle or a business.
Okay.
Because if they do that, that's going to give us more flexibility in how they can earn their income, how they can move, and we'll get into this probably later on, how they can move their expenses around, because that's also a massive barrier, which we'll talk about, of how banks calculate their borrowing capacity. But with the structures, it's very interesting because legally, when you're buying in your own name, it's actually a different legal structure to whether you buy in, say, a company and trust. They actually operate differently. And it's a little bit difficult. If you've never been a self-employed, it's difficult to understand how that all works. But these are things that you really need to take the time to understand when you're first starting out, because, it's actually quite easy to build a portfolio of around 10 properties. But most people never get there because they don't take it to the next level and understand this sort of structuring thing. Because the good thing is that if you start to buy in companies and trusts, there's other parts of the bank which are open to you to lending. So majority of people get their loans through what we call the residential part of the bank. So they might walk in off the street into a CBA branch. They could use a mortgage broker who uses, a range of 20 lenders, and that's all using the residential part of the bank. But there are actually other parts of the bank that want to give you a loan if you qualify. There's places called business banking, there's commercial banking, there's specialised markets, there's private banking, there's even agribusiness banking. There's lots of different parts of the bank which have different ways of calculating their ability to give you money. And so as you're building your portfolio, most people, in our case, we want to tap into different parts of the bank because we're going to get a different outcome. But we have to have other structures in place to do that. So you can't go to business bank and buy a residential investment property in your own name. That's not what they do. That's not their area. Then you go to residential. But as soon as you start using structures, then it opens up the whole banking network to us, which gives us more options.
Sense to me. With your history, right? Like a lot of people do start out in that, they are PAYG and they go in their personal names. Is it that they hit that barrier and then they come to you and say, Stephen, look, I'm struggling. I want to go again, but I can't. It's a pretty common sort of question.
Yep.
Is it more often than not, is it kind of like a sell down strategy to then restructure it from a perfect starting point again in your eyes, or are you trying to, blend that personal name and then building that next level of the portfolio growth, or is it a case by case basis?
It has to be case by case. I start off in the insurance and then financial planning industry, but I sold that business 20 years ago, so I can't give financial advice anymore. So we certainly stick in our lane. We've got our own credit license with ASIC. So that means we can give advice in the financing part. When it comes to things like legal structures and accounting, yes, we're very au fait with it because we've been doing it for 30 years, but we can't give advice. So we give ideas about what our clients are doing, what our successful clients have done, what we've heard, and then we ask them to either speak to their own accountant or we can put them in touch with someone who understands the property flavour of it. So we don't give individual advice. In your question, it is extremely common. Because, yes, we do have a lot of PAYG clients. And some will say, okay, and again, we don't give individual property advice. We do use one particular person who they've got a chartered accountancy background, but they're very big in property. They've done lots of things property-wise. And they provide some property advice to clients as to what they think they can do with these properties. And there's other people out there who do that sort of thing as well, independent of a buyer or something like that. And so some clients may decide, look, I've bought this property in a outskirts suburb somewhere. It's probably got not much potential to grow. It's costing me $10,000 a year in to keep the upkeep. And they might decide, look, this is not the right property for them. It started out as being the right property, but they didn't understand property. Because a lot of people buy property with not really an idea of what they're buying. And it's only when they go to people like yourselves who are experts in that area where they get a bit better knowledge around what they need to do. Is there upside potential? Can I add value to the property? Because at the end of the day, finance is really easy. It's all about income and expenses. And at the end of the day, you've got growth, you've got assets and liabilities. So you've got to look at each individual asset you've got. Can I improve that asset? Can I make more income off the asset? Can I reduce the expenses? And you might determine, looking at this asset, it's a dog with fleas. It's never going to go anywhere. It's not going to give me anything. I'm not going to get much rental growth. capital growth's going nowhere, so I can't release any equity. It's not really helping my portfolio structure. So in that case, if it was me, I probably would get rid of it. I'd bite the bullet. And a lot of it's, I find, psychological. A lot of people don't like selling things. They don't like going backwards. And that's because they don't really have a plan. If they had a plan, they knew where they were going. They knew they had to take this one step sideways or backwards to get that better asset, because that better asset's going to give them more capital growth potential, more income potential, and it's going to help them achieve their goal quicker. So I'd say for a lot of clients I've seen, a very good step is to sell. Just admit, okay, maybe this is not the right asset I've been buying. Maybe we've seen lots of people buy right in their backyard. So they live in one suburb and they start buying around their suburb because they think they're going to drive past it. The amount of properties I've bought I've never even seen is majority of them. I don't even care where it is. I just care, is it going to perform? I don't want to see it. I don't want to spend my time going to some of the suburbs where I bought. I just want it to perform. And I want a good manager to make sure it's going to do what I want it to do.
I heard, Stephen, that if you drive past it more, it goes up in value, though. Have you heard that?
Maybe if you cut the lawn and put a cubby, granny flat on the back and one of your drive-bys, you'd be right.
Yeah.
I'd say, look, sorry, go on.
Yeah, I was just going to say, it's good for your ego to buy in your backyard and make you feel good. But if it's purely you're buying basis on a numbers game like you are, Stephen, I've got a property that's an hour and a half away from me, and I was like, my family's like, "You're gonna go have a look at it." I was like, "No, I don't care. Like, it's gonna make money." And it's a numbers game for us as well.